Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. It's November 5th, 2018. Hope you had a good weekend. Mine was nice. Spent good time with the family. Went to the high school football game. I know high school football, but in town it's a big deal. My daughter's on the kick line, which is kind of like cheerleading, but like the Rockettes for the varsity, and so they kick at halftime. And but our team, I think we've won now in our town. We've won 36 straight games, which is pretty remarkable. And they're in a conference where they just run over people. So they had their first playoff game, ran over someone. And, it's funny, the starters hardly get to play. They play a quarter and a half, and then everyone else plays, which is fantastic. Because if you're part of the team, I think there's 60 kids on the team, and probably they all get in, which is really nice. So it's good to see that. So we did that over the weekend, and just a lot of house stuff, house chores, house errands, ran around, a whole bunch of stuff. And of course, I went grocery shopping, and I don't know how, but along the way, I always leave a bag or two back at the grocery store that I got to go back and pick up and say, no, it was here. I was here an hour ago. I don't know how I do that, but I guess I'm in my own world sometimes. Islanders, let's talk hockey for a second. Again, if you don't like the sports, you don't like the intro, just fast forward a little bit. But I'm looking at the standings right now. The New York Islanders are atop the Metropolitan Division in the NHL with 17 points. Pittsburgh's in second with 15. The Pittsburgh Penguins, the dominant Pittsburgh Penguins. The Islanders have beat twice in the last couple of weeks. And I got to tell you, for me, and I know I have a lot of Canadian listeners, a lot of Canadian friends, a lot of Canadian listeners, because a lot of people who listen, from a mining perspective, uranium and all that stuff, a lot of those, that's a lot of my listener base. And hockey for me is just something that, going way, way back from when I was a kid. Lost my mom at 7, didn't really know my dad. And so I was raised by my grandparents, and sports for me were my escape just from a very early age. And at that time, as the Islanders were just getting started in the early and mid 70s, and I was a young kid, and, it was a new franchise, an expansion franchise, and it was 15 minutes from my house. And they were terrible, like most expansion franchises are. And then as years wore on, they started to get better and better. But I knew every player on that team. I knew every player on every team in the NHL. Now think back. We're going back, 40, 45 years? There was no internet. There was nothing. It was just getting the Goal magazine, going to a game. And if you went to, you'd get Goal, the Goal magazine, and you'd have the rosters. And I would read everything, the sporting news, whatever it was I could get my hands on. And I would memorize the towns. And I would memorize towns like Moose Jaw, Saskatchewan, and for a kid from Long Island, but all the towns in Canada, the small towns where the junior hockey programs were, or where guys were from. And I could at one time I could probably tell you where I knew where every Islander was from, what their journey to the NHL was, and the same with the Rangers, even though I'm not a Ranger fan. But it was for me, it was everything. And years later, when I would, go up into Canada with the looking at companies and whatnot, and somebody will say where they're from, and I'll say, oh, so and so is from there. Like, how do you know that? Well, it sticks with me. But for me, as a young kid without parents, raised by my grandparents who were Italian immigrants, it was really and generationals apart. Excuse me. So much older, no interest in sports, but for me, it was a great outlet. And, and then in the 80 to 84, they won 4 Stanley Cups in a row. And it was I mean, I could remember what I was doing, right? You remember people say that I wasn't born, but people say they remember where they were when Kennedy shot. I remember where I was when the Challenger exploded. But for me, I remember where I was with each Islander playoff game. So fast forward many, many years now, and from really the late '80s till now, the Islanders have just been abysmal. They moved from their home, the Nassau Veterans Memorial Coliseum in Long Island. They moved into the Barclays Center in Brooklyn. They tried to redo the Coliseum, and the Coliseum was, like I said, 15 minutes from where I grew up and 5 minutes from where I live. Don't worry, I've lived in other places and I traveled the world, so I'm not in a bubble. But I when they moved, and so it was nice. I used to take my kids and we'd pop over, go to an Islander game, and then because the county and the state, they couldn't figure out how to fund it, the expansion, the remodeling, the refurbishment, the Islanders moved into Brooklyn, and the thought was, hey, it's Barclays Center, it's Brooklyn, Brooklyn's hip, and we'll get all this corporate crowd. It's a disaster. First of all, their entire fan base. Those of you who don't know, Long Island it's about 120 miles long and I don't know, maybe 10 miles wide. There's a few million people that live here. Parts of it way out east on the island are very, very rural. Just potato farms as far as the eye can go. And then you have this section called the Hamptons way at the tip on the eastern edge of the island on the South Shore, which is, it's right. If your lifestyles are the rich and famous, that's the Hamptons. That's La La Land. That's not reality. But it's beautiful, and there are monster homes, and people live out there. But that's not Long Island. That's for the summer people that come from the city and the rest of the world. That's what they know as Long Island. And then there's the North Fork, which is way out there also, but it's the North Shore of the island, and it's rural and it's country and it's farm still, and it's got its charm, but it hasn't really been populated by the Hamptons crowd, which is nice. And then you have from maybe that 30 miles to the east to the tip, but then all in between, it's suburbia. It is just suburbia, and it is South Shore has one. There's obviously there's the South Shore, the North Shore, and the in between, and the North Shore is more as you come further towards New York City. The North Shore is not rural, but it's still more open space and single lane highways and whatnot. Whereas the South Shore and the central part are really like just strip centers and shopping malls, and there are nice towns and not so nice towns. It's a smattering of everything, but that's the fan base for the Islanders. That's the core fan base. And at the Coliseum, when they were struggling, they would draw 8,000-9,000 people. It seated 16,000. But when they're playing well, you get your 14,000, 15,000. But that's not a modern day arena. So they move into Brooklyn. But the problem is, nobody wants to take the train to go for an hour to go to Brooklyn when your fan base is there. And they never did the corporate thing. And they've been there, I don't know, 4 or 5 years now. The ice is terrible. It's a basket. It was built for concerts and the Brooklyn Nets for basketball. The scoreboard is not over center ice. It's over the blue line. It just looks ridiculous when you're watching it on TV. And I know you all think I'm crazy because I'm talking about this, but it's I don't know. I got off on a tangent, but when you're watching it on TV. Around the glass, right? If you're watching a game from Calgary, or if you're watching a game from Dallas, or, it's in Nashville, right? It's intimate. The lighting is perfect. The crowd is right along the glass. Here, half the rink has no fans along the glass. They have Honda advertisements. It looks like you're watching the Charlestown Chiefs of the old in the minors, right? With the movie Slapshot. It's crazy. Anyway, so the Islanders have sucked, but still. Even to this day, as they've sucked all these years, I still really I pay attention. Now, I can't tell you where every guy is from, right? Life takes over. You become a dad and a husband, and you have to do your job. But I still follow it closely, and I just see them starting to turn. They had the superstar John Tavares, who left. He left free agency, went home, went to Toronto. Really disappointed people because they thought he was going to stay. He had been here 9 years, and it was very exciting for most people that they were starting to turn around. And Tavares is there. He's one of the few superstars, well, not few, but he's one of the superstars in the NHL. And then he said he's going home, which I could appreciate, right? He wanted to play, and he always wanted to wear the sweater, the Maple Leaf sweater. Now, when Tavares comes back to New York, God, it's you're not going to be able to get a ticket because people are the poor guy. He's going to get just roasted the whole night. The crowd's going to go crazy because they just feel like he just abandoned them. But anyway, so the Islanders are playing great. They didn't need Tavares after all. He's doing great in Toronto, and they could have him. And but for some reason, they've got a new coach, Barry Trotz. He won the Stanley Cup with the Caps last year, and now he's come in. He's instituted a great system, defense, and he's playing really. The team is believing in themselves. They're playing hard, but they sit in first place. And I got to tell you, at even at my age, and even right as a lot going on in life, that's like comfort food for me, right? The hockey to me is comfort food, and so it's really great to see, and I've been really excited. And the past week I was in Boston. I spoke at the Nuclear Energy Institute conference, and I think in the last podcast I did the podcast from there on a Monday, and Sunday night, the prior Sunday night, the Sox had just won the World Series. So outside my hotel, it was crazy, and then they were going crazy till 2 a.m, and then when I was leaving on Wednesday, I went to go get my car, and right outside my hotel was the parade. It was just getting started, but luckily I was able to get my car. Like I didn't think I would, but the hotel was great and being able to get me. I get in the car and I realize it's New York plates. And as I'm driving, New York and Boston sports rivalries are pretty crazy. And as I'm getting in the car, there's the whole city is packed and kids are drinking beer, 20-year-old, 21, 22-year-olds, and I'm at a stoplight and people are yelling at me to get out of Boston. It was pretty funny, but it was a nice time. Took at the conference, went with a couple of guys who were from LA, and we went to the North End, which is great Italian food, and we ate at a restaurant called La Famiglia Giorgio's in the North End, and it was just great Italian food. And being of Italian heritage, I could really appreciate that. And I make my own sauce on many Sundays, and so it was nice. And we're going to talk about the NEI a little bit later. And I'm not going to have a guest this week. I'm just going to ramble. I decided I just got some stuff, that I thought I'd talk about. And so, I was there. I was in Boston the week before. I was on a ranch for a couple of days in South Dakota visiting some uranium projects. So, you talk about the tale of two geographies, right? Nothing for as far as the eye can see, and the next closest town was 80 miles, and then here I am in Boston, where it's going kind of crazy. But both really interesting. So I love to do that. I travel less now than I used to, but when you get out there, there's nothing like getting out there and speaking to people, and visiting and asking people questions about their projects, about their industry, and for me, that's how I find most of my insights, right, from going and doing. So really helpful. And so it was a good weekend. And it's an interesting time now, right? You hear me talk a lot. And now if you're an institutional investor, you're probably going to want to check out, right? Because I'm going to talk about some stuff that you might know, you might care about, you might not care about. But I don't do this call for this podcast for the institutional investors. It's more geared towards people investing their own money. So, I was thinking about, you've heard me, I think since earlier in the year, I've been saying, to be cautious with your portfolios. And again, I don't like to come out and call crashes, and every time the stock market dips to come out with all sorts of data like so many commentators do and say, here's why you should not be listening to that. Here's why it's going to go higher. Or conversely, here's why it's going down. I don't view it that way. And I think if you listen to the podcast, you've heard me say, I don't make my bombastic calls, but for me, I just kind of step back and say, okay, well, what's priced into the market? What's not priced into the market? Have we had a big run? What's driven that run? Have we had a tough period? What's driven that period? What are the factors going into that? And probability, where are we on that scale, right? My hands are going up and down right now, like I'm balancing a scale. Like, is a lot of good news priced in, or is a lot of good news not priced in? Or are we hitting a rough patch, but we're still in the early stages, or not? Like, and I think you've heard me say we're kind of 10 years into this thing, right? And I've said just be cautious. If you have companies in the portfolio that have rallied really hard, and they've checked the valuations, right? Now, again, you don't, as a short seller, most of my life, as my professional life, you don't short anything on valuation. But if you own things, you have to have a catalyst, right? It has to be fundamentals declining and a catalyst. And if the valuation's egregious, that helps. But if you short something based on valuation, you're going to get run over. Because who are you to be the arbiter? Who am I to be the arbiter of what somebody's willing to pay for a stock? Read Tesla. But we did get out of that position in the newsletter, made a little bit of money, and more on that to come. The 10Q was just filed, but I don't want to get on a Tesla tangent. All sorts of goodies in there, which makes me very excited. But I kind of think about things. Where have we come from? Where are we now? What's going on? What are people pricing in? What risks are they pricing in? What risks are they not pricing in? And you've seen a lot going on. We'll talk about in a second but as I think about what's gone on here, right? And we think about the market and really what the October sell-off, right? So it was growth concerns. Right, that kind of precipitated it. What's the fear in the market right now? Right, some rising interest rates. Now, all of it's a fear now, right? Because the Fed is taking rates up, and we've seen LIBOR go up quite a bit. But when rates were where they were, where were they going? Were they going lower? No. So rising interest rates, right? You've got these deepening trade tensions between the U.S. and China. You're definitely seeing a slowdown in some foreign economies, right? That's no surprise. And but on the other hand, you've had tremendous earning growth. And I know commentators come out there, podcast hosts and other commentators on TV. My God, we're putting up a couple of consecutive quarters of over 20% earnings growth. The economy's fantastic. It's tremendous. Buy. And and I've said, well, sure. Yes, that driven tax cuts have helped a lot, right? Share buybacks have helped a lot. But the market doesn't really care what it's doing today. It wants to know where it's going to go in the future, right? So I think a good earnings quarter so far. I think 3/4 of the companies have reported, and it's about in line with where expectations were. I think actually a little bit better coming into the quarter. I think it was 19% earnings growth was expected. I think it's coming in 23, 24%. But next year it's going to be 9-10% earnings growth, right? So it's rate of change that I focus on. It's not so much rate of change going forward, right? Is it going? What's the rate of change? So if earnings are still growing next year, but they're growing at 9 or 10%, coming off at 24%, well, the market starts to price that in a little bit, and then it kind of looks at the valuations of the companies and the growth rates, and that all starts to get factored in. Now you layer on top of that this uncertainty, and that makes for a tough call. And what I've been saying all along is, listen, you've had some stocks, you've had some, you might, I don't know what your portfolio looks like. I got a lot of different listeners, but I don't know, you might have some growth, you might have a little bit of momentum stocks, you might have some speculative stocks, you might have some dividend payers. But if you've got some speculative stocks, or you have even letting that now after this big run, if you have, regular companies that you think are safe and they've had huge moves and you're up big, take a look at them. Take a look, right? I don't know how you do your research, right? I don't know if you use Value Line. I don't know if you just surf the web. I don't know, because there's a lot of listeners. But look at what the valuation is, right? And then go back and look over years and say, what's it typically trade at? How's it trading versus the sector? Is it at a premium or a discount? How is the sector trading on a valuation standpoint, whether it's your PE or your EV to EBITDA, right? Or EV to free cash flow, EV being enterprise value. How does the sector normally trade, right? What's the historical valuation? What are the growth rates when it achieves that valuation? What are growth rates now? What are growth rates important going forward? What are they going to look like? If I have a stock that historically trades at 12 times earnings, is trading at 18 times earnings right now, and earnings have been okay, how did they get those earnings? Was it revenue growth? Was it margin expansion? That's pretty healthy, right? If you can grow revenues, you can get a little bit of pricing power, you can take your margins up, right? That's good. Gross margins, right? Your sales minus cost of goods sold being gross margin. Or did it come from huge cost savings, monster cost-cutting plans? Where did the earnings growth come from? Did it come from major cost cutting, but no revenue growth? Look at it. You can see. I don't know if you use Yahoo, whatever you use. I use Bloomberg, so most of you are not going to be using a Bloomberg. But if you use Yahoo or whatever you use, look, what's the trend been? Right, revenue growth stagnant. If you see very flat revenue growth, maybe a drop, maybe a little bit more than a drop, but really big earnings growth. Where'd that come from? Was it massive layoffs? Was it a huge cost-cutting program throughout the system? Did they restructure the cost base, and where did they do it? Is it repeatable? Was it a 1-year program, a 3-year program? Is that why the stock went higher? Look at the share count. Did it shrink a lot? Okay, if the share count shrunk, you might want to think about, well, okay, so they bought back stock. Shares outstanding declined. Look at the balance sheet. Did debt go up considerably, right? Did they go borrow money to add debt to the balance sheet at low interest rates and buy back a lot of stock? Nothing wrong with that. But do they have the room to buy back more stock? Leverage. Did they have net debt to EBITDA? That's a leverage ratio. Or did they go from 1 time to 4 times? 1 time to 3 times? Right? Then look at the filings. What do the filings say? Do they have more room? There are credit facilities. Are there covenants on the bonds where they can't go above a certain leverage ratio? Because if they can't, and they've been just with revenue growth, and they had this big cost-cutting program, and it's kind of going away, and they borrowed and they bought back shares. When you buy back shares, you reduce the share count, which, all things being equal, will make your earnings look better. But now maybe they don't have room to do that. So now how are they going to buy back stock? Right? Those are the kind of things you want to think about. And it's a prudent time to have done that this year, right? You've had a monster move, right? The tax breaks and fiscal stimulus has just driven everything. There's an old saying, right? Bulls and bears make money and pigs get slaughtered. So that's all it is. It's just taking it and saying, okay, I don't know how people are positioned. Am I 90% in equities? Did I used to be in, was it more of 50-50 equities and fixed income? And I rotated out of fixed income. Great, did a tremendous job. Yeah, right, you've done well. But how am I now? What's the composition of my portfolio? Is it ETFs? How are they doing? Don't just assume they know what they're doing. Or the mutual funds, right? Because these guys are having it's momentum now. Now it's all about driving and performing like your peers. So my tone has been, and my message has been to the podcast listeners and to my subscribers is just be cautious. There's nothing wrong with being prudent. And if you leave a little on the table, so be it, right? Because math. If the market were down 30%, you got to be up more than 30 to make that money back, right? It's just simple math. So if at this point in time you started to trim your positions a little bit, not the worst thing. So here comes October. The S&P was down 7. It was down 11 at one point. Tech stocks were down 10, something like that. They got hammered. So what was that? Well, a lot of that, right, is, I think, right, so we talked about rising rates, China trade tensions, foreign economies, but then you have, right, what's going on in the U.S. from a U.S. perspective. You got the midterm elections, right, and that's a big deal, right? They take place tomorrow, November 6th, right? And really what's hanging in the balance that people are focused on is how they'll dictate the balance of legislative power in D.C., right? Up for debate is, will the Democrats take majority control away from the Republicans in the House and Senate? Because in the House and Senate, the Republicans control it, right? Pro-business, House and Republicans, right? Will the GOP, right, the Republican Party, are they going to keep majority control in both houses? Is it going to be a split Congress? Well, right now, conventional polling wisdom is kind of saying it's going to be a split Congress with Democrats holding a majority in the House, and Republicans maintaining a majority in the Senate. So the midterm elections, I think, have weighed a lot on this market, and in addition to the other things that I mentioned. Look, it's going to come, it's going to pass. The market's like certainty. So when you have these financial things going on, rates, trade wars, economy slowing, and you layer on top of that the uncertainty about what's going to happen in the biggest economy in the world, in the biggest economy in the world, and because it could swing one way or the other, based upon who gets into office, that could change, right? Because growth concerns, right? Think about what would a split Congress be bad, right? Well, depends, right? Do they roll back any of the stimulus that was put in place, right? Will they stand if the Democrats took control of the House, would they stand in the way of passing additional fiscal stimulus and try and stifle the efforts that have already taken place with reducing regulatory burdens? The market might not like that. But the market knew November 6th was coming. And so it starts to price that in ahead of time. So layer on top of all the stuff we just talked about, now the political uncertainty, and you start to come into what we saw in October. Now, does it go further? No idea. Right, a little bit. I think the market was up a couple % last month. So where it goes, I don't know. But again, I still hold the view that if again the market wants to know, tell us what it is. Mr. Market says, tell us what it is, and we'll figure it out. If we don't know what's going to happen, if we're not sure, then we're probably going to be cautious. You hear me talk about risk off. Well, that's kind of risk off. Risk on is, hey, you know what? We're good. We're not that concerned about stuff. So, I think you need to think about right now. The market is still uncertain. Tomorrow evening, we'll know. There will be certainty if the market has a relief rally, right? So how do I view that? Okay, well, if the market just wants to know, and it said, okay, the Democrats here, you might gyrate for a little bit. People say, oh God, they're going to roll back regulatory burdens. They're going to try and repeal the tax decreases, and who knows? The market could sell off a little bit, right? Or conversely, the market might say, hey, you know what? At least we know now, and we're going to move it higher. I would use that as a time to, again, lighten my portfolio a little bit, to reallocate. But it's all about preparation, understanding, what do I have? Why do I own it? What's it worth, right? What's it worth? And if you own story stocks, right? Because at the end of the day, if you own a story stock, it's built on the story. And when there's a risk-off environment and people, it's all, good times, low interest rates, people are rotating into equities, and it's like we've seen in the last decade, story stocks do really well. They can do really well, right? Because the people pay less attention to the numbers. When it starts to become a risk-off environment, the numbers matter. So just try and jumpstart, you get ahead of that, right? Start thinking about some of those things that, can make a difference in the equities. So it's just kind of all about being prepared, and numbers matter in this business, right? Stories are good. Stories are one thing, but at the end of the day, the numbers will take over. The fundamentals will take over. You don't always know when, but it's about growth. It's about, right? Do you have too much leverage? Can you pay off the debt? Are you going to grow? Will your earnings grow? And at some point, stories fade. So I think it's important to pay attention to that. And speaking of that, so I was at the Nuclear Energy Institute conference last week, and I spoke. If you listen to the podcast, I have an investment firm that is focused on the nuclear fuel cycle and the uranium mining industry, and I have investment vehicles that invest in that. And I do speak publicly a lot about it, and I'm asked to speak a lot at different places. I stood up there and I talked to the buyers about how I view the environment, and I talked to them about what a good job they've done over the last several years back in March of 2011, there was an earthquake off of the coast in Japan, and it caused a tsunami. And I'm sure many of you have heard of the Fukushima nuclear reactor disaster, right? And that caused all the Japanese reactors over a period of time to go offline because of safety concerns. And it was about 13% of world demand. And so they went offline, and it caused a backup in the supply chain and the price of uranium, which at one point at its peak was $137 in 2007. When Fukushima happened, it was about $73. And the nuclear power, the price of uranium settled down a year and a half ago or so at about $17. And if you're in a developed world and you are a nuclear fuel buyer, you're a nuclear power plant, in the U.S. or let's use the U.S. for example, it's difficult because while nuclear power is a baseload power, it's always on, and it's reliable and it's clean. It's 100% carbon free versus any except like hydro. It's safe. When you look at it on a per terawatt hour, it's extremely safe. It's one of the safest forms of electricity generation. And obviously people don't focus on that. They focus on 3 Mile Island, Chernobyl, and Fukushima, but the numbers would bear out how safe it is. I'm not going to get into a debate on that, but you saw. But if you're in a place like the U.S., you're competing against half the reactors. There's 100 of them, and half of them are in a market that is regulated, where they have fuel riders, where they could go to the state regulators, the public utility commissions, and if fuel goes up, they can pass that on. Ratepayers pay for it ultimately, but they can pass it on. If you're in a competitive market, an unregulated market, well, you're competing against other fuel sources. And right now, natural gas with the U.S., with the shale plays where they're pumping out so much natural gas, it's been very difficult for them. Now, I argue that the actual cost of uranium is just mid-single digits percent, and whether it goes up or down, it's not that material to them. And there's a debate around that. The whole front-end fuel cycle, enrichment, conversion, and all the other stuff could be, it could be 18%, but the U308, the uranium, is not that much. But to the fuel buyer, it is, right? That's their job, and they're going to try and get the best price. And over the last 7 years, they've held out of the market. I won't get into all the reasons why, but they've held out of the market, and the price kept coming down, and good for them. While conversely, the uranium mining companies were increasing production for many of the years during the downturn. And as I said to the fuel buyers, shame on them, right? That during a downturn, you didn't have the foresight to cut production. Because if you cut production and produce less, you bring the market supply-demand imbalance in line. Instead, they diluted their shareholders a lot over the last several years. But like in why I love investing in deeply, deeply cyclical industries is because ultimately supply and demand will balance out. If you have way too much supply, the response is to cut supply. And when you cut supply, it depends how deep. You might have to go shallow or deep, but you got to bring that market back in balance. And that's how you get prices, right? There's the saying, the cure for low prices is low prices. It will resolve itself because when you bring supply demand in balance or it goes into a deficit, it starts to rise. So I spoke to them about that, and I said, listen, you guys have done a great job. The miners, really, many of them should be ashamed of themselves for increasing production. They've diluted shareholders, but now you know what? And I showed them our work, and we're just going to get into my talk about numbers. At the end of the day, there's a cost to produce something, and if you look at the supply, here's your primary mine supply, and here's the secondary supply, and here's the demand. Now, when you're talking to a room full of a lot of Western developed country nuclear power people, there's somewhat of a state of depression, right, for the reasons I just spoke about. But the growth isn't there. The growth is coming from the developing world, the emerging markets. That's where all the growth is coming from. And nuclear power, net, when you look at the developer and developing world, is growing. It's a low single-digit grower. It just is. Take all the closures, get draconian on your assumptions, and add the new reactors coming online, and look at what's down the pipeline, and it's growing. So I just shared that view. Here's primary supply, here's secondary supply, and here's demand. See that white space? That comes from new mines. And those new mines, if you think about how long it takes to license, permit, and build a uranium mine, it could be 10, 15 years for some of them. And I said, here's a list of all the mines, every one of them, that can go into production. And here's the price they're going to need to go into production. And it's at least $50. Now it trades at about $28 per pound now. So, and you have to think in terms of dog years. All these projects, most of them, not all, but most of them have stopped all their permitting and licensing and all the progress made on them, because why would you go and spend money to do this advancement of a project when you're going to sell something for 28 and your costs are much higher? And most importantly, the economics of the project, the ability to get project financing, are based on $50 uranium. And what I shared with the buyers was, here's all these mines coming on, and here's every one, and look at the price needed. And oh, by the way, many of these are older reports. There's mining inflation. And oh, by the way, when they put these reports out there based on this price, it's their best foot forward, right? When I look at these reports, I don't take that at face value. I go through them and I could add 20, 30, sometimes higher percent in what I think it's going to be. And, so we talked about that. And at the end, and I showed them. And at the end, the talk was over, and somebody walked up to me from industry and said, wow, that's an interesting perspective. I know you've been public and you've been out there, but I just assumed that you were a mouthpiece for the uranium miners. And I laughed. I said, I'm sorry. They said, yeah, you're always talking about how the fuel buyer should be buying uranium. So I thought you were like a pro uranium mining company. I said, I'm a pro nothing. I'm supply and demand, and it all comes down to the financials and the economics of a business. Right now, at this particular point, I think the uranium mining industry that offers the best risk reward of any investment I've seen in my career. But that's now, and over the years, who knows how that's going to be. But I'm not talking for anyone. And I said, you should hear me on the phone with some of the CEOs. If you're investing capital, you're not there to placate anybody. You're there to understand the business dynamics, the fundamentals of the business, and the economics of the business, and hold management teams to be responsible with their business. And this person said, wow, that's interesting. I just kind of thought you were bullish because you're pro uranium mining. And I said, yeah, and I have respect for this person. I know this person. I said, you got a minute? Here, let's open up my laptop. And we spent the next hour and a half where I said, and again, this is where I talk about, it comes back to numbers. I said, let's go through my model that I've spent 3 years building, and why I have the conviction I have. Now, it doesn't mean I'm right? There are things in models, sometimes you have a lot of assumptions. I think I'm right. I feel I'm right. My experience tells me I'm right, but I could be wrong. But I don't think I am. But that's markets, right? You make your bet, right? You're bullish, you're bearish, you're neutral, you're whatever. And I walked them through, and I said, look, here's a list, as you can see, of every nuclear reactor on the planet. Here's a list of all the closures that I think are coming. Take a look at by country, by year. Here's what I think is, not what I think, but what's in the pipeline that's coming online. Here's the amount of uranium that gets used when a new reactor comes online. Here's the amount of uranium that gets consumed by the average reactor in the world. And here's the size of the old ones. Here's the size of the new ones. Here's all the list of prospective mines and all the economics of those mines, right? And here's how it all feeds into the main model. And here's all about enrichment. It's a big part of the uranium fuel cycle. You have to enrich uranium that comes out of the ground so that it could work either as nuclear fuel or a nuclear weapon. And here's the amount of secondary supply in the market by underfeeding. It's part of the secondary supply market, by government sales, by mixed oxide fuels, by year. Here's the inventories in the world by country, commercial versus governmental. Here it is in Japan. Here it is in the US. Here it is in China. We go back all these years. Here's supply-demand gaps that I think. Here's reactor constructions by reactor, by country, by when they come online, right? 20 tabs. I think it's 20. That all feed into a main model, and I could change different numbers as I do my research, and that will change the outcomes, right? And then it's objective, right? So it has assumptions, and if those assumptions move up or down, that's what you do during the day or whenever you do it. And when that changes, it changes the outcomes. But if I'm standing up in public and talking about something, it's not because I like nuclear power. It's not because I like the uranium mining guys. Really nice guys. A lot of hockey players too. Because a lot of them are Canadians. But you could damn well rest assured it's based on math. And the thing is, every one of you listening, it's fourth grade math. It's addition, subtraction, multiplication, division. Yeah, once in a while, maybe a little algebra in there, but you can figure it out. But it's not complicated math. It's grinding. It's work. It's digging. It's uncovering. It's going to speak to people. It's peeling, reading, a nauseous amount of reading, and reading, and more reading, and talking, and more talking. But if you do it over the years, right, you can kind of get to it. So that gives me conviction. Now I'm just talking about, I'll give you an example. And the person said to me, holy crap, I had no idea. I had no idea. And again, doesn't mean I'm right. It means this is my work. This is my best effort at thinking I'm right. And it's why I love industries that are ignored. It's why I love industries that are left for dead. It's why I love the trash pile. Because there are so many smart people working, and I use hedge funds because that's my 20 plus years of experience. And I mean, the IQs, the intelligence, people are off the charts. And it's not about one thing, it's about everything. Talk geopolitics, talk economics, talk anything you want. Most of those people in those offices are pretty well versed at it, right? But the goal is they all want to manage a lot of capital, a ton of capital, right? Billions. And when you get to that point, you're all looking at the same stocks. So you got really, 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 really bright people looking at the same stocks. And then you got the mutual fund guys, right? Yeah, hedge funds get paid for outperforming every year, and they haven't done that in quite some time, by the way. And that's a whole structure. I've talked about it before. But mutual funds, right? They want to do well, of course, for their investors, but they want to be around their benchmark. The hedge funds need to make money for them to make money, be positive. So for the people running these firms. But a lot of really smart people looking at it really the same thing. And when everyone's doing the same thing, it usually doesn't work. And hedge funds are, right, they're short some stuff. So they have net exposure. They're not 100% long the market, and that's why they underperform during these melt-up periods you've seen the last decade, with the exception of a few hiccups in there. But for me, the junk pile, nobody's paying attention. Nobody's looking. Nobody cares. Nobody wants to put the effort in. It's left for dead. And in those sectors, when things are left for dead, change occurs. It's human nature, right? If you've been a nuclear fuel buyer for all this time during the downturn, you look great. You haven't entered into 7 to 10 year long-term contracts. You've been buying at spot or short-term contracts. Home run. If you're a uranium mining company, oh my God, I've heard this before. It's going to turn. It's going to turn. It's going to turn. It never turns. Meanwhile, the reasons were wrong. So, all it was for years, Japan's coming back online. Japan's coming back online. Well, they haven't come back online. But you know what? Markets adapt, right? Supply has been cut finally. Secondary supply enrichment. At the conference, two of the big enrichers stood up and said, we did a survey, over 90% think there's way too much inventory. Actually, there's not. And actually, we're not underfeeding as much as we were. Underfeeding has been a big source of secondary supply. That was a surprise to people. So, but what happens is you can find those surprises when nobody's paying attention. Very few. I shouldn't say nobody, but very few. Because if you're living in the world, if you're a trader, a buyer, a miner, you're living this every day. Oh my God, this is a disaster. It sucks. It's terrible. And you miss the fact that nuclear power is a growth business. You miss the fact of the changes occurring every day. This one cut production, that one cut production, this one went out of business, that one went out of business, less supply, less supply, less supply. Less supply is a good thing when you have a market imbalance with really low prices, right? It's a good thing to bring the market back in balance. And then people don't believe it. We've heard it before, we've heard it before, we've heard it before. Well, yes, but you know what? All the things that needed to be done weren't being done. And now in the benefit of hindsight, right, for me, 3 years, I started looking at uranium 3 years ago. I didn't have all that history. I'm a generalist. I know supply demand. I came at it with a fresh set of eyes. And so when I think about that, so now, numbers, you got to do numbers because you could get caught up in the story. And that leads to looking at a lot of when you're looking at mining companies in any industry, you got to remember during downturns, companies are always looking to raise money, right? Mining companies, many of the junior ones, because they need it. They need it to stay afloat. So of course they tell you their costs are really low and they're all in the lowest decile or quartile. They're not. They allocate them differently. But you'll hear all of these things. And by gosh, how many of you listening that invest in resource stocks are geologists or mining engineers, right? You can get sold a bill of goods. I'm not a mining engineer. I'm not a geologist. I'm not a nuclear power engineer. I know how to find those people who are, talk to them, understand them. And after a while, I've looked at a lot of resource reports over my career, and I know what I know and know what I don't know. And what I don't know, I go find out. But it's easy to get told a story, right? But the story always falls apart when the numbers come into play. So that's why you do the numbers. So when you're, looking about it, if you're investing in the resource space, think about it, right? You have to have assumptions. I don't know how many people listening use Excel, but maybe you're a legal pad guy and an old-fashioned calculator and legal pad. You can still think about it, right? If you were building a model in Excel or you were building a regular model on paper, you'd have to think about what are the assumptions that go into this? Am I looking at gold? Is it grams? Do I have to convert grams to troy ounces, right? Because the reports will say different things. If I'm looking at uranium, is it tons of uranium that's processed? Well, how many pounds is going to come out of that? What's the grade, right? What's the grade I have to convert to the grade, the tons to the grade, and that tells me how many pounds are going to come. I need to know if I'm thinking about it. What are the assumptions out there? What's management saying? What did the consensus of the analysts say? What's spot market, right? And what should I base my numbers off of, right? Well, the market is where the market is, and then over time, if you've done the work on the macro, you could kind of get a sense for where you think pricing might be. But when you're looking at one of these companies, you want to understand, like, what's the grade? What's the recovery rates? What's the mine life? How many years? Is it a few years? Well, that's not exciting. Is it long life? Yeah, that might be exciting. Is it, the longer the better? What are the resources, right? What is it? Are we talking measured and indicated? Is it proven and probable, right? Is it inferred with measured and indicated, right? Measured being the highest conviction level if you're looking at a uranium miner, indicated being pretty good, inferred being, yeah, we think it's there, right? Know the category, right? Gold, proven, probable. What are the reserves, right? Any byproducts in there? Is there a byproduct from what they're mining? And if they're mining it, can they sell that? And if they sell that byproduct, it's a cash credit against their costs. So how much does that bring their cost down? What's the strip ratio, right? You want to know what that is. Any royalties they're paying, right? So if you're thinking about the math, here's how many pounds they're going to pull out of the ground, and here's what the average selling price is going to be. Any royalties they're paying against that? They might, right? What are the operating costs? Big one. What's it cost to mine it? What's it cost to process it? What's it cost to transport it? What's the general administrative cost to do it? What's the cost to explore? Right? What's the cost to do further exploration on that project? What's the cost to do exploration across the projects, right? So there's corporate exploration costs, there's project exploration costs. What are the capital costs? What's the upfront capital costs? What's the sustaining capital to keep it going? Another big one, what's the reclamation costs, right? You got to reclaim that land. How much is it going to cost to do that, right? You want to think about the working capital. How does it work? How do they sell it, right? They bring in drillers, they bring in outside sources to do all this stuff, so they have an accounts payable. How long is it going to take them to pay it? How big is that accounts payable going to be, right? And then they sell the stuff. Who do they sell it to? How long does it take them to get paid? How many days of inventory are they going to keep on hand, right? That's a big deal. What's another assumption? Discount rate, that I'm going to discount to get my net present value on, right? 8%, 10%. What's the acquisition cost of the project, right? So you need to start thinking about what's the milling schedule. Are they processing it themselves, or are they paying a toll milling agreement to get it out there? What's the cost per ton to process internally or to sell and send it out, right? So you need to think about that. But your big variable being the prices you assume, right? The big assumptions. And then really you take all those assumptions and you start to put it into, well, what's my revenue? What are my unit operating costs, right? My capital costs, my all-in costs, right? So, right, because it's not just a cash cost. The cash cost is just one thing. And all that stuff, right? You take your revenues minus your costs, and you're going to come up to an EBITDA number, earnings before interest, taxes, depreciation, amortization, right? Then you're going to say, okay, well then I'm going to take depreciation out, right? And you're going to come up with a EBIT number, earnings before interest and taxes, operating income. Then you back out your taxes, you come to net income. So now you're working your way down. And then you right, if you don't know how to do it, you could look it up. You could do a DCF model, discounted cash flow model. Very good in mining to do. You want to come, you take your EBITDA. You want to less your adjustments, your capital expenditures, your taxes, your working capital changes, the reclamation costs. You get total adjustments. That's going to take back that out of your EBITDA number. You're going to get an unlevered free cash flow number. You're going to apply a discount rate. You're going to try and what's the net present value of the asset? What's the purchase price? What's the net present value? You can look all this stuff up. I just don't have time to do that math for you on an Excel spreadsheet here. I have it. But I don't have time to walk everyone through this. But I'm telling you things to look for. What's the payback period of this project? How many years? And then you want to do sensitivity analysis, right? So what's my transaction's net present value? What's the break-even price of the commodity, whatever I'm looking at, that I'm going to need for this project to at least break even? And then you sensitize it, right? You want to sensitize it to a different price of the commodity and sensitize it to your different costs. Right, and that's going to give you an internal rate of return. Right, so these are things you want to think about. So, again, it comes back to numbers. If you have a framework, you're less susceptible to the story. It's easy to fall prey to the story in any industry, especially the mining industry. Right, so to have a framework for doing some math. My framework for doing math on the macro for uranium was 3 years of toiling and grinding and reading and talking to people and building models, building a master model from all those things I talked about that feed into one main model. But none of that is high finance. None. It's a lot of work, but it's you don't need an MBA from Wharton to do that. I can promise you that. Same thing with the companies. If you have a framework for assumptions, revenues, costs, does it square with what others are telling you? Most of these companies have feasibility studies, pre-feasibility, definitive feasibility. Before that, they'll have a pre-economic assessment. They'll lay out what the project's going to cost, what the project is going to, how much revenues they're going to get. All the stuff I just talked to you about. Look at it, read it, go to the websites under technical reports. You might start from scratch. Your first one, you have no framework. Look at 3 or 4 other companies. Are the costs per whatever ton they're telling you for processing, transportation, G&A, are they reasonable? Are they in line with others, or are they really low? If they're really low, why? Ask them. So, or if you can't get to the management team, read about it, right? Ask people in the industry. Go to LinkedIn. LinkedIn's great. Find a mining engineer. Send them a note. Say, here's who I am. Here's what I'm thinking about doing. You got a second? You'd be surprised. Anyway, it all comes back to the numbers. At the end of the day, the numbers will dictate what goes up, what goes down. Not in the interim all the time, right? Sometimes it could be quarters, it could be years, but at the end of the day, you got to have a framework. I just want you to think about that, and especially with story stocks, because anyone can tell a good story. You can hire anyone to tell a good story, but is it supported by the math? So anyway, that's my little chat on where I on the numbers. We're going to wrap it up here. I kept it, I think, right to an hour, shockingly. Again, to review, the Islanders are in first place with 17 points, sitting atop the Metropolitan Division in the NHL, 2 points ahead of the multiple Stanley Cup winning Pittsburgh Penguins. Just in case any of you weren't aware of that, if you missed that in the early part. We'll know tomorrow what the midterm elections look like. Who knows? I have no idea. I mean, I pay attention to it because I have to. I think all politicians are full of shit. Just my opinion. Sorry. I'm so jaded by them. But anyway,
I just want to let you know that I am the co-founder and chief investment officer at Sachem Cove Partners, LLC. And due to industry regulations, I don't discuss any of Sachem Cove's funds on this podcast. And all the opinions expressed by the podcast participants are solely their own opinions and do not necessarily reflect the opinion of Sachem Cove or its affiliates. And this podcast is for informational purposes only, and it should not be relied upon as the basis for investment decisions. Clients and or affiliates of Sachem Cove Partners may maintain positions in securities discussed on this podcast.
Hope you have a good week, and I'll be back and chat with you next week. Take care.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.